If you own REITs or you've been thinking about investing in real estate, here's the news you've been waiting for. The Federal Reserve just cut interest rates. That one move could change the dividends you earn and the growth you see in 2025. So what does this really mean? Will REITs hand more money back to shareholders? Will stock prices climb? Or is there a hidden downside? In this episode of CTRL Cash, we're breaking it all down. And if you find this video helpful, make sure to subscribe and hit the bell so you don't miss the next one. If you've been following the Federal Reserve this year, you know the market has been watching Jerome Powell like a hawk, trying to predict every move on interest rates. Well, the big news just dropped. At their most recent meeting, the Fed decided to cut the federal funds rate by 0.25%. That might not sound like much, but it's a big deal. Now, if you're not familiar with the Fed funds rate, here's the quick version. It's the interest rate banks pay to borrow money from each other overnight. That rate sets the foundation for the entire economy, because when it goes down, it ripples out into rates we all see on things like mortgages, car loans, credit cards, and personal loans. In other words, a small move by the Fed can make a big difference in your wallet, and for investors, it could really shake up sectors like real estate and REITs. Now, if you don't know what a REIT is, I already made a full video breaking them down and highlighting some of the best monthly payers out there, so definitely check that one out after this. But here's the short version. REITs are basically companies that buy up income-producing properties. Think apartments, offices, warehouses, even data centers, and then pay out most of the rent they collect to shareholders like you and me in the form of dividends. Here's the catch though, property isn't cheap. Over the last 5 to 10 years, home prices have skyrocketed, and even just a 20% down payment on a single property is a hefty chunk of change. So what do REITs do? They borrow huge sums of money to buy more properties, then cash flow from the rent, and this is exactly where lower interest rates come into play. When the Fed cuts rates, it does three big things for REITs. First, it lowers their monthly payments to lenders. If a REIT borrows on a variable rate, instead of paying, say, $500 a month in interest, a cut might drop that to $450. That's an extra $50 the REIT keeps and a bigger cushion to increase dividends for shareholders. Second, it lets REITs refinance older, more expensive debt. Remember, mortgage rates recently hit around 7%, which is a record high. If a REIT locked in debt at those rates, lower interest rates give them a chance to refinance and save money every month, again, freeing up cash for dividends or reinvestment. And third, lower rates expand the universe of profitable properties. When borrowing costs are high, a lot of deals just don't pencil out. But when rates drop, suddenly more properties become viable investments. That means REITs can grow faster, expand their portfolios, and increase income flowing back to shareholders. Now, here's something important to know. Historically, when the Fed cuts rates, the stock market usually rallies. Why? Because lower interest rates make it cheaper for companies to borrow, expand, and grow. So not only do REITs save on interest payments, they typically see their share price go up as well. On top of that, investors start moving their money out of safe bonds, which now pay less, and into riskier assets like stocks, hoping for higher returns. That extra demand pushes stock prices higher. But, and this is a big but, you've got to remember why the Fed usually cuts rates in the first place. Most of the time, it's not because the economy is booming. It's actually the opposite. Rate cuts are often a signal that growth is slowing down, inflation is cooling, or a recession might be around the corner. So yes, stocks and especially REITs can benefit in the short term from cheaper borrowing costs. But at the same time, if the Fed is cutting because the economy is weakening, that could mean fewer tenants renting space, more vacancies, and slower rent growth. In other words, a rate cut is kind of a double-edged sword. Alright, so let's take a step back and look at what's actually happened to REITs during past rate-cutting cycles, because history gives us some pretty good clues. For example, just last year in 2024, when the market started pricing in rate cuts, listed REITs rallied hard. Studies by firms like Franklin Templeton and Cohen & Steers show that REITs typically outperform when interest rates are falling. Why? Because their two biggest costs, debt payments and property financing, suddenly get cheaper, while the rental income they collect usually stays steady. That combination is like rocket fuel for cash flow. In fact, if you look back at earlier easing cycles, like after the Great Financial Crisis or even the pandemic in 2020, REITs were some of the first asset classes to rebound once rates started dropping. Historically, early in those cutting cycles, REITs have delivered some of their strongest risk-adjusted returns compared to other equities. Now, that doesn't mean every REIT is guaranteed to soar the moment Jerome Powell cuts rates. Performance depends a lot on the sector. Industrial REITs and residential REITs might thrive, while office or retail REITs could still struggle if the economy weakens. But on average, the trend has been clear. When interest rates go down, REITs have tended to go up. So what's the big picture here? Rate cuts are generally good news for REITs because they lower borrowing costs, make refinancing easier, and open the door to more profitable property deals. Historically, REITs often have rallied in early stages of rate cutting cycles, sometimes even outperforming the broader stock market. But not all REITs are created equal. The ones with strong balance sheets, lower debt, and steady rental income are positioned to benefit the most. And remember, if the Fed is cutting rates, it typically means the economy is in trouble. So what do you think? Is it better to invest in REITs now, or is it better to wait on the sidelines and see how interest rates affect the economy? Let me know in the comment section below. If you enjoyed this week's episode of CTRL Cash, make sure to hit that like button and subscribe for more no-nonsense finance breakdowns. And if you haven't yet, check out my video on the top 5 REITs for 2025. Until next time, keep investing, keep stacking dividends, and I'll see you in the next one.